Hello everyone, welcome back to the fourth week. Today I'm gonna explain to you about capital structure. So I already made this word for you too easy to read when I will just explain it truly. So capital structure is a balanced comparison between foreign capital and your own capital. So you can, in this case, maybe a long-term and short-term debt, and then in fact the company's debt ratio is below the target level. The capital expansion will usually be carried by issuing debt. So yeah, it's normal for a capital, especially a multinational company, to make loan and debt so they can reduce their taxes. And there's also a rate of risk and return. So being lots of debt, you're going to have a high risk, and the share price is down. By reducing debt or multiply the equity, you'll get high return and increase share per share. So you have to find the equilibrium between the debt and equity. So the factors affecting capital structure decision, you can find it like the business risk, what will make it difficult for companies to implement external funding, and then the tax position. One of the main reasons of using debt is the interest can be tax deduction. Uh, and profitability. The companies with high profitability net income certainly have more internal funds, of course. So it correlates with each other, yeah, the debt and equity. Then opportunity for growth also, and then also the firm size. And the formula in agency cost exchange or tax protection model, you can measure the risk by using the expected return, the risk of expected return. You can find the standard deviation, the coefficient of variance, and the beta coefficient. And also you can find it by using capital asset. CAPM, I will explain later. So you can find the expected return. So if you invest your money in a stock and in the capital, you want to analyze how much percentage will I get, and you can use it by using this formula. And you can also measure the standard deviation. The standard deviation is to find out how far it's possible that the value return obtained deviates from the expected value. So the standard deviation, you have to find it also, because it's not you can determine how accurate is it by using this standard deviation. And also the beta coefficient to compare with the stock that like JKSA or HSG, the portfolio. So you can find it, you can compare it, and it's a parameter that measures the expected change in stock return. If there is a change in the market index return, if the beta coefficient is more than 1, it indicates the asset is more volatile. Yeah, and you can also, you're reducing the risk using diversification. You can give a price risk capital asset pricing model to analyze the risk rates of return and to find out the expected return or cost equity of a stock. So it's more accurate to find with JAPM. So yeah, the risk-free rate, it's you can find it on the internet. How is the risk-free rate? How to find it? I think it's around 7% in Indonesia, and then the beta stocks, and then the market return, and you can find the conclusion. Okay, guys, I think that's it for this week. I hope I will explain about WACC in the next week. I'll see you, and thank you for watching.